$240 million poured into a brand new asset in 24 hours. You'd expect the price to launch into orbit, right?
You'd think so.
Absolutely wrong. The price crashed 2.7% instead. This is insane. We are diving into the hidden truth. Wall Street is keeping quiet about the mechanical reason behind this paradox. You won't believe the forces that actively work against the biggest crypto ETF debut of the year. We're going to show you exactly why this crash was necessary and what it signals for the $40 billion future of this asset. Stick around.
We've taken our proprietary analysis page by page to show you exactly why this historical event happened and, what comes next. Understanding the crucial lag time between institutional inflows and actual market purchases is the key to mastering this volatility. You're with Channel Best, your expert in ETF strategies.
Okay, let's dive right in and confront the central conflict that has everyone, scratching their heads.
Let's do it. The 240 EM XRP ETF paradox.
So this is the headline that shattered expectations. I mean, the biggest XRP ETF launch in history absolutely broke records, attracting $240 million in capital in a single day.
A huge number.
Yet instead of soaring, the price collapsed by 2.7%. This wasn't just investor disappointment. This paradox exposes hidden structural market mechanics that automatically separate the sophisticated institutional money from the emotional retail crowd. The headlines were screaming validation, but the charts screamed panic. Tell us more about the raw contrast we saw.
Okay. Record-breaking launch meets price collapse. The initial data was, it was phenomenal validation. Canary Capital's XRPC ETF volume hit $58 million on day one, crushing every other 2025 crypto debut record.
Right.
Bloomberg's Eric Balchunas correctly cited this as, unprecedented institutional validation. But in the hours that followed, XRP plummeted from $2.50 down to $2.28.
Oh.
It's vital to understand that this price drop was not investor disappointment. It was the buy the rumor, sell the news market rule playing out mechanically exactly as it's designed to do.
But how can $240 million entering the market not instantly move the price?
Yeah.
It sounds like the money's acting like a ghost.
Yeah.
What's happening inside the system?
Well, this is the core of it, the mechanical lag mystery. This is the crucial time delay, the lag, that causes this short-term price movement failure. We broke this down into 3 stages. On day one, $240 million enters the ETF.
Okay.
However, the authorized participants, the APs, who are these massive financial institutions creating and redeeming the ETF shares, they don't immediately buy XRP on the spot market. They fulfill the new shares using existing inventory, over-the-counter desks or futures contracts.
Wait, why aren't they buying on the spot market right away? Who are these APs and why do they even hold inventory?
They hold inventory and use OTC desks, large private trading floors, to ensure the ETF launches smoothly and to manage risk without causing massive initial price spikes. And that leads us to days 2-3, the gap. The ETF funds now hold the $240 million in cash, but the funds aren't fully collateralized with the underlying XRP yet.
Ah, so there's a disconnect.
A big one. And sophisticated traders immediately exploit this temporary imbalance, often selling into the spot markets, creating that initial pressure we saw.
Right.
It's only on days 4 to 7. Mechanical buy that the APs finally complete the spot purchases to fully collateralize the funds. That's when the real buying pressure arrives, but unfortunately, retail investors have typically already panic sold.
And you're saying this isn't new?
Not at all. We saw identical lag patterns in both the Bitcoin and Ethereum ETF launches.
Here's where it gets really interesting, because the market wasn't just dealing with this mechanical lag. It was dealing with an environment where all the easy fuel for rallies had already been burned off.
Exactly. Derivatives devastation. Before the ETF even arrived, the massive leverage in the system had just evaporated. We tracked XRP futures open interest peaking months earlier in July 2025, maximizing speculative leverage.
Okay.
By October, we saw a brutal 63% crash in just over a week due to a liquidation cascade.
How much was that in dollar terms?
That's $6.35 billion worth of leverage destruction. This removed the essential volatile fuel required for explosive, fast rallies. So when the $240 million ETF inflows finally arrived, instead of rocketing prices higher, they were merely competing with existing spot holders for limited liquidity, which seriously dampened any immediate upside.
And if the leverage was gone, who was actively selling into that $240 million inflow? Our next data point reveals the silent strategic exit of smart money.
The whale distribution pattern. Our data from CryptoQuant showed a crystal clear distribution pattern throughout October and November, precisely as retail excitement was peaking due to the pending ETF news.
So they were selling into the hype.
100%. We tracked over 108 million XRP transferred to exchanges, signaling that previously dormant supply was awakening at the highest level since July. We even noted 21,595 new wallets created in 2 days alone, November 5th and 6th, reflecting peak retail FOMO.
Classic.
It's a textbook wealth transfer. Whales accumulated cheaply months ago and strategically distributed their holdings right into the retail euphoria generated by the ETF hype.
And look, if you want us to continuously track these whale movements and technical strategies, please subscribe right now and comment below telling us whether you are bull or bear on XRP.
Even with the short-term mechanics explained, we have to look at why institutions are hesitant to jump in instantly with bigger checks. It really comes down to stability. XRP's volatility problem. I mean, institutions managing billions demand stability and risk management, and XRP simply doesn't provide it yet. Our analysis shows its 170% volatility rate, which makes it 2.3 times more volatile than Bitcoin.
2.3 times.
Yeah. When fund managers see potential daily swings of liver 50 cents, they don't immediately rush in to buy more, even when the ETF structure is in place. This high volatility acts as a natural speed bump, forcing large-scale institutional accumulation to wait for stability and, calmer waters post-launch.
Volatility isn't just an abstract risk number. It fundamentally impacts how funds assess their mandated targets. And the numbers here, when you compare them to competitors, are honestly brutal.
They really are. Risk-adjusted returns tell the real story.
We use the Sharpe ratio to measure return per unit of risk. For context, Bitcoin has a solid Sharpe ratio of 0.75, and Ethereum, which currently boasts the best risk-adjusted returns among major cryptos, sits at 0.90. But XRP,
its Sharpe ratio is only 0.31.
So to be clear, you're saying a fund manager has to take almost 3 times the headache and risk to get the same or potentially lower returns they'd get from Bitcoin.
Precisely. Mathematically, XRP requires 2.9 times more risk for the same return compared to its peers. This single metric perfectly explains why Bitcoin attracted $4.5 billion in its ETF debut, while XRP received only $240 million.
So they're just dipping a toe in.
Exactly. Institutions treat XRP as a small, specialized 2% portfolio sleeve at best until that risk profile stabilizes.
And speaking of risk, you can't look at this asset in a vacuum, especially when the overall macro environment starts to turn negative.
You absolutely can. The correlation trap. We found the XRP Bitcoin correlation is extremely high, sitting at 0.89. But here's the trap. When Bitcoin crashes, XRP crashes even harder, operating with a high 1.2 to 1.3 times beta. This means $240 million in inflows is, it's negligible when the overall crypto market, due to macro headwinds, just lost $1 trillion in market cap in November 2025.
A drop in the bucket.
Exactly. Furthermore, its VIX correlation is 0.42, which confirms XRP is definitely not a safe haven asset and suffers acutely during broader market panic.
If we zoom out, the biggest revelation is that this entire episode, the inflow and the crash, it wasn't a unique failure. It was a predictable historical pattern.
Yes. Historical ETF launch patterns. The crash was 100% predictable because the pattern matches exactly what we saw before. Look at the comparison. The Bitcoin ETF launch in January 2024 saw $4.5 billion volume, but a day one decline of 3.2%.
Okay.
Its major rally didn't begin until month 2 or later. The Ethereum ETF launch in May 2024 saw $1.07 billion volume, declining 2.1% on day one. Its rally began in weeks 2 to 3.
And XRP.
The XRP ETF launch saw $58 million volume and a day one decline of 2.7%.
So just following the script.
The conclusion is clear. XRP isn't underperforming. It's performing exactly as expected for a volatile altcoin ETF launch in a down market. Recovery is likely weeks out.
But wait, if the ETF inflows led to a crash and the short-term volatility is so high, why did the smartest money in finance still commit hundreds of millions to the ecosystem? The real conviction isn't in the ETF itself, it's in the underlying utility.
This is the key insight, the institutional conviction signal. This is the $500 million validation that separates long-term belief from short-term speculation. While retail was chasing ETF hype, major firms Fortress Investment Group, Citadel Securities, Pantera Capital, and Galaxy Digital committed $500 million directly to Ripple itself, valuing the company at $40 billion.
They invested in the company, not just the token.
That's the difference. That investment is based on a multi-decade utility thesis, not just ETF gambling. They are focused on real utility, like the MasterCard partnership enabling RLUSD settlement and the company's existing $95 billion annual payment volume infrastructure.
This is where that short-term patience pays off. Because that $240 million that just entered the market, that's just the appetizer. You won't believe the pipeline that's lined up behind it, waiting for regulatory clearance.
That's right, the regulatory catalyst pipeline. A huge wave of multi-billion-dollar inflows is waiting on SEC approval. We are tracking Franklin Templeton, which already has the XRPZ ticker on the DTCC pre-launch list. Grayscale has filed amendment number 2 and is near ready.
And there are others.
Oh, yeah. Bitwise, Invesco, 21 Shares, and WisdomTree all have pending applications. If the SEC approves Franklin Templeton next, we could see an additional $500 million to $2 billion in inflows across multiple funds simultaneously.
Wow.
That's when the mechanical lag stops being a delay and becomes a mechanical rocket. Stick around to hear our probability targets.
To give you a complete picture, we need to look at both the pessimistic downside and the massive upside, informed by all the data points we've just reviewed.
Let's lay it out. Bull versus bear. The ultimate showdown. We assign a 65% probability to the bull case. This relies on the institutional avalanche bringing in $5 to $10 billion from multiple simultaneous ETF approvals, strong utility growth at the MasterCard and Gemini partnerships, and continued support from Ripple's $40 billion private valuation.
And the price target there.
If this plays out, we see a price target of $3.50 to $4.25 by Q2 2026. Conversely, we assign a 35% probability to the bear case, driven by that $6.35 billion leverage collapse, continued whale distribution, and sustained macro weakness.
And that puts the price where?
That places the target at $1.80 to $2 by Q1 2026. And hey, if you find this strategic breakdown helpful, please subscribe right now to Channel VEST and drop a comment below telling us if you are bull or bear on XRP.
So we have two strong scenarios. But what does the math tell us about the expected outcome when we blend those probabilities together?
It gives us our investment thesis. Probability-weighted expected return. This gives us the mathematical verdict, justifying our strategic entry. We take the 65% probability of the bull scenario, which represents a plus 52% return, and blend it with the 35% probability of the bear scenario, which is a negative 13% return.
Yeah, that goes out too.
The result is a mathematically sound plus 26% blended expected return over the next 12 months with managed risk. This emphasizes the need for a calm strategic entry rather than, chasing volatile short-term headlines.
Based on that positive mathematical expectation, we need a discipline plan. Our framework outlines exactly how to accumulate strategically without falling victim to the inevitable market panic during dips.
Right, precisely. Strategic entry framework.
We recommend a tiered accumulation plan to manage that volatility and risk effectively. Tier 1, targeting $2.15 to $2.25, should be 40% of your total allocation, representing a 70% conviction. This is a key technical support zone.
Then Tier 2, at $2 to $2.10, takes 35% of the allocation, offering deep value at 65% conviction. Finally, Tier 3, at $1.90 to $2, takes the remaining 20% allocation, providing extreme value if the long-term utility thesis remains intact.
And there's a hard rule here, right?
A critical rule, absolutely. Never add below $1.80. That signals a structural breakdown requiring a complete thesis reassessment. So let's put it all together. Your action plan, decision day. Our final recommendation, based on the full analysis, is strategic accumulate with a conviction rating of 7 out of 10. Our base case target remains $3.50 to $4, which offers 52% to 74% upside in the next 12 to 18 months.
And the safety net.
We advise a hard stop loss at $195. The timeline demands patience for 12 to 18 months. And remember this quote, "The difference between institutional winners and retail losers is patience, positioning, and probability. Execute the 3-tier accumulation. Let time and real-world adoption do the work."
So what does this all mean for you? The initial crash wasn't a signal of failure. It was a predictable mechanical lag amplified by the necessary destruction of excess speculative leverage. The institutions that truly matter, the ones who invested $500 million in Ripple itself, are focused entirely on long-term utility, the $40 billion valuation, and partnerships like MasterCard.
Exactly. Now, consider this provocative thought. If the SEC approves Franklin Templeton, Grayscale, and 3 other ETFs simultaneously, resulting in, say, $3 to $5 billion of total inflows on the same day, how does the mechanical lag play out? Is the initial dip magnified by sheer volume, or does the sudden, enormous demand override the initial delay? How does your patience change based on that future regulatory schedule?
That's the question you need to be asking yourself right now, because the real show hasn't started yet.
Before we go, we must provide the mandatory disclaimer. This analysis is for educational purposes only. Cryptocurrency investments carry substantial risk, including total loss of principal.
Please consult your financial advisor.
This is not investment advice, DYOR.
Don't forget to subscribe to Channel VEST to master your ETF strategies. We'll see you on the next deep dive.